Welcome to the deep dive. Today, we're going to be tackling financial derivatives. You've given us some academic excerpts on the topic and a research paper that links these instruments to the U.S. mortgage meltdown. That's a connection I didn't see coming.
Yeah?
Our goal today is to break down the basics of derivatives, see what types are out there, and then, yes, uncover that link to the housing crisis. Let's dive in. First things first, what are financial derivatives?
Well, financial derivatives get their value from something else, an underlying asset.
Okay.
Stocks, bonds, commodities, even currencies.
Hmm.
It's like a bet on how that asset will perform in the future.
So it's not like owning the thing itself, but having the side bet going on.
Right.
Makes sense. One excerpt mentioned two main ways people use these derivatives, hedging and speculating. Hedging sounds like playing it safe, trying to protect yourself.
Exactly. Businesses use derivatives to hedge against uncertainty. Think fluctuating interest rates or commodity prices. Imagine needing a large amount of oil in 3 months. You could buy oil futures contracts today, locking in the price and avoiding a potential price spike if oil suddenly gets more expensive.
I see, that's like buying insurance for your business.
hmm
But speculating, that's where things get more interesting, right?
It definitely involves more risk.
Yes.
One source had a clever analogy using grades. Would you take a guaranteed B in a course, or risk it all for a chance at an A even if you might fail? The guaranteed B is hedging. Going for the A is speculating.
I'm usually a risk taker, but in this case, I think I'd take the B. Now, we've got this idea of derivatives bets on underlying assets, but they come in different forms, don't they?
Yeah, let's explore those forms.
Okay.
First up, forward contracts. These are agreements between two parties to buy or sell something at a specific price on a future date. One example talked about locking in the price of beer for an end-of-semester party.
That's one way to make sure the party budget doesn't go flat. So it's like pre-ordering your beer at today's price no matter what happens later. Smart move.
It protects both the buyer from price increases and the seller from price drops. Everyone wins.
So where's the catch? There's got to be a downside.
Well, the downside is that forward contracts have limitations.
Okay.
Finding someone willing to take the other side of the deal can be tough.
Hmm.
They're not easily traded, and there's always the risk someone might back out.
So they came up with a better solution, right? Futures contract.
Exactly. Futures contracts address those limitations.
Okay.
They're standardized, traded on exchanges, and have safeguards to minimize the risk of someone not following through.
Hmm.
Think of them as more refined forward contracts.
And exchanges like the ones in Chicago, they make this whole system work smoothly.
Absolutely. They connect buyers and sellers, ensure the contracts are uniform, and manage the trading process. One source even mentioned a copper futures contract that specified everything: amount, quality, delivery date, and whether you settle in cash or with the actual copper.
Very organized. Now let's get back to hedging. How does a business use futures to manage risk?
Say a company sells oil. They could hedge against price drops by selling oil futures contracts.
Okay.
If the market price falls below the contract price, they make a profit on the futures contract, offsetting losses on actual oil sales. If the price rises, their futures losses are offset by higher profits from selling oil at that higher price.
It's like balancing on a seesaw,
Yeah.
minimizing losses on one side while maximizing gains on the other.
And the price of these futures contracts, they're influenced by what the market thinks will happen in the future.
Hmm.
One of our excerpts mentioned that futures prices can actually be lower than current market prices if people expect prices to drop later on, maybe because of changes in supply and demand.
So it's not just about what's happening now, it's about predicting the future.
Right.
That makes it even more complex.
Which leads us to another type of derivative options. They give you the right, but not the obligation, to buy or sell an asset at a set price within a specific time.
One excerpt hinted at these options, and I have to admit, they sound a little bit like a choose-your-own-adventure. You get to decide what happens.
Exactly. And there's a cost for that, right? You pay what's called a premium. We have call options, where you have the right to buy, and put options, where you have the right to sell. The beauty is your potential loss is limited to the premium you paid, but your potential gains could be significant.
Okay.
Of course, the person selling the option faces the opposite. They have a lot more risk.
Whoa. That is a big difference in risk. I wonder if people realize they've probably encountered options in everyday life, just not in finance. Like a rain check for a concert. You have the option to reschedule, but you don't have to.
That's a great example.
Yeah.
Options are all around us, not just on Wall Street.
So we've covered forwards, futures, and options. What's the last type of derivative we need to know about?
Last but not least, we have swaps.
Okay.
Swaps are agreements to exchange future cash flows. One excerpt used the example of an interest rate swap between a savings bank and a finance company.
So they're swapping financial obligations. I'm picturing a complicated handshake with lots of paperwork flying around.
Well, imagine a savings bank has lots of fixed-rate loans, but thinks interest rates will rise. They could swap with a finance company that has variable-rate debts. The bank agrees to pay the finance company a variable interest rate, while the finance company pays the bank a fixed rate. If rates rise, the bank's swap payments increase, but that's balanced out by the higher income from their fixed-rate loans.
Right.
The finance company benefits because their variable rate payments decrease as rates rise.
That's a clever way to manage risk. So swaps allow parties to manage risk by exchanging financial obligations, essentially customizing their exposure to things like interest rate changes.
It's all about finding ways to mitigate uncertainty in the financial world. And as we'll see, these derivatives played a surprisingly significant role in the mortgage meltdown. One of the sources, a research paper, explores the factors behind the 2008 housing crisis and draws a parallel to something called corporate undercapitalization.
Now things are getting really interesting. Undercapitalization. That sounds like a recipe for trouble, right? Tell me more.
Well, undercapitalization occurs when a company has too little equity compared to its debt. It's a situation where owners or shareholders have very little to lose if the company fails, while the creditors bear most of the risk.
So if the company goes bust, it's not the owners who really feel the pain, it's the lenders.
Exactly. And the research paper argues that homeowners taking out certain types of mortgages were actually in a situation very similar to those shareholders in an undercapitalized company.
Now I really want to hear more. But let's save that for part 2, shall we? It sounds like we're about to unravel a fascinating connection here.
So we were talking about undercapitalization and how it played a role in the mortgage meltdown. It all comes down to risk. Who's taking it on, and what happens when things go wrong?
That's what I'm eager to unpack. You mentioned homeowners being in a similar position to shareholders in an undercapitalized company. How did that happen?
Well, think about it this way. Limited liability is a fundamental concept in business.
Okay.
It means shareholders are only responsible for what they've invested. If the company fails, their personal assets are protected.
That makes sense. It encourages people to invest without fearing total financial ruin if the company tanks.
Right. But it also has a potential downside. It can lead to what economists call moral hazard.
Oh.
It's the idea that when people aren't fully responsible for the consequences of their actions, they're more likely to take big risks.
So if a company is undercapitalized, those shareholders might make risky bets knowing they won't be on the hook if things go south.
Exactly. They stand to gain if things go well. But if the company fails, the creditors bear the brunt of losses. And the research paper we're looking at draws a direct parallel to the mortgage crisis. Certain types of mortgages, particularly those with no down payments, created this same type of moral hazard.
So some homeowners were essentially making risky bets with the bank's money because they had nothing to lose if housing prices dropped.
That's the key point. They had very little skin in the game. And this brings us to a crucial question. How do companies become undercapitalized in the first place? Is it just that shareholders decide to invest very little when the company is formed?
That's what I would assumed, but I'm guessing it's more complicated than that.
There's a more subtle way.
Okay.
Instead of investing money as equity, shareholders can lend money to the company. That's where things get interesting.
Wait, wouldn't lending money to the company actually increase its capital? I'm a little lost here.
It's about the difference between debt and equity. When you invest as an equity holder, you're last in line to get paid if the company goes bankrupt. Creditors are first, then whatever's left goes to shareholders.
So equity holders are taking on more risk than lenders.
Exactly. Now, when a shareholder lends money to the company, they become a creditor, just like a bank.
Okay.
And in bankruptcy, creditors get paid before equity holders.
Right.
So by lending instead of investing, they're reducing their risk.
Ah, that's sneaky. They get to minimize their risk while still profiting if the company succeeds. It's like having your cake and eating it too.
It is. And this ability to disguise equity as debt makes a moral hazard problem even worse. But here's the thing. There are legal remedies for this kind of behavior in the corporate world.
Okay.
One powerful tool is piercing the corporate veil.
Piercing the corporate veil. That sounds intense. What does it mean?
It means the courts disregard the legal separation between a corporation and its shareholders, holding the shareholders personally liable for the company's debts.
So in extreme cases, the owners can't hide behind that limited liability shield anymore.
Right. It's reserved for situations where there's clear evidence of abuse or fraud. It's like lifting the mask to reveal who's really responsible.
Got it. But what about less extreme cases? Are there other legal tools that can be used to address undercapitalization?
Absolutely. There's another tool called subordination.
Okay.
It specifically targets shareholders lending money to the company.
Okay, break that down for me. How does subordination work?
Basically, the courts can rearrange the order in which creditors get paid during bankruptcy.
Mm-hmm.
They can rule that a shareholder's loan is treated as equity instead of debt. This pushes those shareholders further back in line to get paid.
It's like the court is saying, nice try, but you can't pretend to be a regular creditor when you're actually one of the owners trying to protect yourself.
Exactly. Subordination helps level the playing field. Now, you might be wondering if these legal tools exist, why weren't they used to prevent the mortgage meltdown?
That's a great question. It seems like those tools could have addressed the moral hazard we were talking about, right?
Here's where the distinction between corporate finance and the housing market becomes crucial. Those legal remedies we just discussed are designed for corporations, not for individual homeowners.
Ah, so it's not a simple case of applying the same solutions. We need something tailored specifically to the housing market.
Exactly. Remember, the research paper is highlighting parallels between corporate undercapitalization and the mortgage crisis. But the housing market has its own set of rules and regulations.
So what are those rules and regulations, and how did they contribute to the crisis? That's what I'm really curious about.
Okay, so we've established that the housing market operates under different rules than the corporate world. But what were those rules, and how did they lead us down the path to the mortgage meltdown?
Well, the research paper focuses on two key features of the U.S. mortgage market that magnified the crisis:
Okay.
non-recourse mortgages and the elimination of down payment requirements.
Non-recourse mortgages, we touched on those earlier.
Right. It's where the lender can only go after the property itself if the borrower defaults, not the borrower's other assets.
Exactly. In some states, if the house value plummets, the borrower can simply walk away, leaving the lender to absorb the loss. It's essentially a walk-away option,
Okay.
much like a put option in the world of derivatives.
So it's a safety net for the borrower, but a potential risk for the lender. I'm starting to see how this connects to the undercapitalization issue. But where do down payments fit into all of this?
That's the second piece of the puzzle. Eliminating down payment requirements essentially gave borrowers a free option to bet on rising housing prices.
It's like getting a free lottery ticket.
Yeah.
You have the potential to win big with very little risk.
And just like options, these free options in the housing market introduce something called nonlinearity. Small changes in one variable, in this case housing prices, could lead to massive changes in outcomes.
Nonlinearity, that sounds complicated. Can you give me an example that's a bit easier to grasp?
Imagine a small crack in a dam. It might seem insignificant at first, but if the water pressure builds up enough, the tiny crack can lead to a catastrophic collapse. That's nonlinearity in action.
Okay, I'm getting the picture. So a small dip in housing prices could wipe out a homeowner's entire equity if they had no down payment. And with a non-recourse mortgage, they can just walk away from the whole thing.
Precisely. Combine those factors with the rise of securitization, where mortgages were bundled and sold off as investments, and you have a recipe for disaster.
It sounds like everyone was passing the hot potato, assuming someone else would be left holding it when the music stopped. But what can be done to prevent this from happening again? Are there solutions that address these specific features of the housing market?
The research paper proposes two alternatives. One focuses on what to do before a mortgage is even issued, the ex ante phase. It suggests a mandatory minimum down payment for non-recourse mortgages.
That seems like a logical step.
Yeah,
It ensures borrowers have more at stake, more skin in the game, making them less likely to default.
exactly. It aligns the incentives of both the borrower and the lender, reducing that moral hazard problem we discussed earlier. Those free options, fueled by no down payment requirements, were a major contributor to the housing bubble.
Okay, so a minimum down payment makes sense. But what about after a mortgage is issued, especially if someone defaults? What happens then?
That's where the second proposal comes in. It addresses the ex post phase.
Okay.
It suggests a system of limited personal liability for borrowers who didn't make a down payment.
So instead of just losing the house, those borrowers would face additional consequences. Wouldn't that discourage people from buying homes, especially first-time buyers?
That's a valid point.
Yeah.
But this limited liability could be designed to find a balance. It could be tied to a percentage of the debt or phased out as the borrower builds equity.
It's not about punishing borrowers. It's about making sure they have a stake in the outcome.
Exactly. The goal is to promote sustainable home ownership.
Right.
It encourages responsible decision-making and reduces the risk of another meltdown.
These solutions sound promising, but can they truly prevent another crisis? The financial world is constantly evolving, finding new ways to take risks.
You're right, there are no guarantees. But the key is to learn from the past. Understanding the dynamics of risk, leverage, and incentives can help us create a more resilient financial system.
So in a way, we need to become financial detectives, constantly searching for clues and patterns that could signal potential trouble ahead. It's like a never-ending game of financial chess.
And every move we make individually and collectively shapes the outcome of the game.
Well, I think this deep dive has given our listener plenty to think about. We started by demystifying financial derivatives, exploring their types and uses. Then we uncovered their surprising connection to the mortgage meltdown, drawing parallels to the corporate world and the dangers of undercapitalization. It's been quite a journey.
It has been, and it highlights the importance of financial literacy. The more we understand about these complex systems, the better equipped we are to make informed decisions and navigate the financial landscape.
Absolutely. So to our listener out there, we encourage you to keep exploring, keep asking questions, and keep learning. The world of finance may seem daunting, but it's also fascinating and full of valuable lessons.
And who knows? Maybe you'll be the one to uncover the next big insight that helps us create a more stable and equitable financial future.
Thanks for joining us on this deep dive. We hope you found it enlightening and thought-provoking. Until next time, stay curious.